Welcome to the weekly update, where I'll go over the action in the market for the week of August 14th through the 18th, and then we'll see how things look for the week of August 21st through the 25th. Now, you might detect right away that I sound a little bit different and the screen might look a little bit different. If you haven't been watching the daily videos, I've had to start recording in a little different way for the time being. I injured my arm this past week, and believe it or not, it makes it very painful to work the mouse on the computer. Some kind of a nerve issue. And so I have to record it this way. When I do record this way, I'm not able to update or edit anything as I'm going along. Everything is take one from start to finish. So you're going to get my mixed up words. I'll trip over myself. I'll have pauses. I'll probably have to clear my throat a few times. So I apologize in advance for that. Hopefully, you'll still find this video useful and well worth the time to go ahead and watch it. First of all, before we get started, there will be a PDF of all the slides that I use in this video. It's always put right in the description below the video. And sometimes you might want to download those and look at the charts. You might be able to zoom in or make some notes or something that you see in the charts that maybe I didn't cover. I also do a condensed version of the daily video. Now, for the time being, I've merged the condensed version and the regular video into one because I'm recording that the same way here. It's coming out to kind of split the difference between the two as far as time is concerned. I just am not able to do both videos for right now. I'll try to get back to that as soon as I can. I do have a private Facebook group, and if you want to join that group, just send me a request. The link is in the description below this video, and you would be more than welcome to join. I will post a new poll. I'll go through the results of the latest poll, and you're welcome to take part in that. After I do this video, I'll look at updating the poll. I do really keep an eye on YouTube comments. You're welcome to post whatever you'd like, whether you agree, disagree, that's fine. It's the garbage and bot comments that I know are fake. Those are the ones that I'm going to get rid of when they have nothing to do with what we're talking about. I want to keep this as a good, healthy back and forth between us. Also, at the end of this video, I give you an email address where if you want to contact me directly, you're more than welcome to do that. I also post these same videos on Rumble. Here is the link to the channel. If you can't find me on YouTube for whatever reason, look for me on Rumble and vice versa. Also, I do plan on doing a free online course in September. I haven't nailed down the actual dates yet. I'm having some personal on again, off again commitments kind of getting in the way with when I would be teaching this class. It looks like it'll be 3 hours long, either 3 hours in one shot or 1 hour spread out over 3 days. I was thinking of Tuesday, Wednesday, Thursday, because here it is the summer starting into the September month where we're going back to school. And I thought maybe that would be a little bit easier, but I might have to shift it to Monday, Tuesday, Wednesday. If I do the full length class, I'm not sure if it'll be Monday, Tuesday, or Wednesday. As soon as I get that nailed down, I will post the actual dates. I will be recording it as well. So if you can't attend, you're more than welcome to watch the recording. I'll be going through my approach to technical analysis. I'll also be covering some very basic strategies that you might want to consider implementing. And I'll also be going through support and resistance. I'm planning on about an hour for each one of these areas. All right, let's go back and talk about the session. For the week, we were down 2.11%. We've had another down week now, but volume still remains below average. We're in the middle of summer. There's a lot of folks on vacation, so volume is really dropping off. We also had a really good run up into the end of July. People are wondering, is this just a pullback or are we getting ready to head much lower? And we'll go through the charts and have them tell us what it looks like might be happening. The technicals were still positive on the weekly charts. We've switched over to negative on the daily charts. In the short term and even intermediate term, we're starting to look oversold. We're also potentially seeing a convergence of some different signals coming together that sometimes signal that we're at a bottom. Now, if we hit those signals and then just keep blowing through to the downside, that would negate this. But if you want to go through the daily video and see what I've been picking up to this point, that might be well worth your time. It's all about inflation and interest rates right now that are also producing growth concerns. More or less a little bit of concern coming out of China because their economic data has been weak lately, and a lot of US companies do business in China. I have that as a bullet point here in just a second. And we're still dealing with earnings season, but that's starting to trail off a bit, but there's still earnings that come out every day. Our trend is strengthening and it's still positive, but we're starting to roll over with the ADX. And I'll show you that chart. The green line, even though it's on top, is declining, where we're more negative when we look at the daily charts. So for the week, the Dow was down 2.2%, the Nasdaq down 2.6%, the S&P down 2.1%, and the Russell 2000 small caps were down 3.4%. So here's some bullet points just for the week. The major indexes or indices, depending on how you want to say that, they all closed with losses, but it was on below average volume. Interest rates and the dollar were up overall for the week, and that is pressuring stocks. The stock market likes lower interest rates, and it also likes a weaker dollar. Well, the opposite of that happened. The current scenario that the market's been developing, we had been going off of a positive scenario. Now we're switching over to a more pessimistic scenario that the economy is stronger than expected. Yeah, that could be seen as a bad thing, especially in the bond market. That's why bonds are going down and interest rates are going up. And that could also impact stocks. And that the Fed will need to keep rates higher for longer. We've kind of already known that once they get these rates jacked up to where they think they should be, they're going to keep them there. They're not going to immediately turn around and start lowering rates. And if the economic reports coming out continue to be strong, they might have to actually go in and raise rates, which the market's kind of wondering about that currently. We did get the FOMC minutes this last week on Wednesday. There weren't really any surprises from that, but right after they came out, there was some initial gyration. There was a headline that came out that said most participants continue to see significant upside risks to inflation, which could require further tightening of monetary policy. This is kind of a known thing and kind of where we knew the Fed was at already. So after the market gyrated around, it just kept declining after that anyway. There are some global growth worries that I alluded to. China came out with a bunch of reports on their retail sales, their industrial production, their fixed asset investment data, and they're also seeing a decline in their home prices. So what did they do? They cut their rates to try to stimulate their economy. They're the second biggest economy in the world. So when something happens to them, we need to pay attention because a lot of US companies are involved in that. Also, it was reported that the property developer Evergrande, they filed for Chapter 15 bankruptcy protection, but in the US. And if you've been paying attention for very long, this is not a new story. It's kind of been lingering around for quite some time. Bank stocks were also weak. Fitch came out, remember, a week before last when they downgraded the US debt? Well, they came out again and said that they might be forced to downgrade the ratings of a lot of banks. Also, last week, Moody's cut the rating of 10 small, mid-sized US banks. Now, one of the things that we've been watching for is this banking situation. We had it really blow up in March. We've kind of been doing okay since then. But in the background, we've been wondering, is this going to lead to something else, especially if we stay in a higher interest rate environment with inverted yield curves? That eventually could affect some of the banks. That's kind of what started the whole meltdown in 2007 into 2008 was a banking issue. So we're just kind of keeping an eye on that whole scenario. And then earnings reports, some were good, some were bad. Even though if it was good, the market got hammered or the stock ended up getting hammered. If it was bad, maybe it ended up going up. It's crazy to try to figure those things out. This is a chart that I've shown a couple of times now where it takes the CPI or the inflation rate back in the 60s, and we're kind of mirroring that a little bit when we compare it to what's been happening lately. The blue line is what's already happened. That was 66 through 82. The gold or yellow line, it is what's happening right now. And we're going along with this fairly well. What we see for the immediate future is if we stick along the same path, there has been a decrease in inflation. But on the other hand, look at what happens after that. This is the late 70s. And if you were around at that time, you had to deal with this. So we just saw massive inflation going up. Is this going to play out this way? We don't know. This is just a little guide that we use to give us an idea what might happen based on what has happened in the past. All right, let's look at our poll results. The first one, and I did it a little different this time where I pop up the questions one at a time. The first question, so far, the longer-term S&P 500 and NASDAQ 100 have remained near their very long-term trend lines, and I'll have these charts to show you later. Do you think they will drop below the trend line? 43% said yes. They will go above it. 14%. They will stay near the trend lines. 43%. We have dropped down a little bit, but we're still not all that far away from those trend lines on either index. Secondly, during the last week, and I love how I spelled the word Ben here. Of course, it didn't come up in spell check because Ben is spelled right. I just needed another E in here. There is Ben. Now that's even better. And yes, I teach English. Can you tell? There's a slight rotation from growth into value as stocks have been under pressure. Do you think this will continue? Everybody thought so. Now, in the latter part of this week, we're seeing growth coming back just a little bit. We'll have to see if this stays in that same general trend. Also, based on Tom Bowley, he sees, based on his research from May through August, where growth tends to outperform value. We're not really seeing that all that much other than the last few days this week as the market's been going down. But all of you thought that it's going to continue, and that would be more of a negative sign for the market. We're getting out of growth and getting more into value. That's a defensive measure that a lot of the smart money does before we're getting ready to go lower. During pre-election years, the S&P often exhibits some strength in mid-August. Well, here we are. Do you think this will happen? 50-50. Yes and no. We really haven't seen that. In fact, we have not seen that as of yet. Currently, the S&P sits above its 50-period simple moving average. Do you think this will offer support? 56 said yes, 44% said no. It did not offer support. All of the indexes, in addition to the S&P 500, are now underneath their 50-period moving average. Some of them are even heading down to their 200-day moving average. I don't want to go through any Isabel Net blog charts right now. I just want to get through my charts. Also, I didn't have anything to download as far as FactSet earnings are concerned. Apparently, I forget the gentleman's name that writes those articles. He must be on vacation. That has not been updated. And while I'm thinking about it, I haven't been including the current marketvaluation.com charts as well. Those haven't been updated since the end of July. So whoever does that is on a pretty long vacation. Let's get into our charts and analysis. Here's the intraday chart. It's a little hard to see what happened on Monday. That was more or less flat. But then coming into Tuesday, this is when we saw a gap lower and we ended up finishing lower. On Wednesday, we tried to get above the daily pivot. That seems to be the main resistance level on an intraday basis that the market's really dealing with. We hit that on Wednesday, only to go down. We gapped higher up to the daily pivot and then went down below that. And then we gapped lower on Friday, thinking, well, maybe this will lead to some kind of a move. And this was fairly positive. We were able to close just a little bit negative, but we never got above the daily pivot for Wednesday, Thursday, or Friday. Well, you could say Tuesday, but we really didn't hit it all that much. So for the week, all of the indexes ended up being down, with the NYSE being down the least, and that's our broadest measure that we look at. The NASDAQ and NASDAQ 100 were down the most. Going back to the beginning of the year, the NASDAQ 100 and the NASDAQ are still up the most, followed by the S&P, and all of the other indexes are still positive on the year. Going back to the all-time high set in early January 2022, all of the indexes still remain negative, with the small caps taking up the rear, being down the most since that time. Keeping an eye on our sectors, and this goes for the full week, Friday to Friday. And since we were down, I ended up sorting it this way. With discretionary, what's been pretty good in 2023, it was down the most, followed by real estate, which is still in a pretty significant downtrend, and communication, which has been another stronger area. It ended up being down. The financial sector, which was looking like it might be improving, no, it got hit this past week. And then at the bottom, the one that was down the least was tech, and energy was also ended up being down the least. Here's our relative rotation graph where we still have discretionary. That's the green one right here. Even though it's showing some weakness, it's still doing about the best when we look at all of the different sectors. Then we have communication, which is showing some weakness. And then we have tech. That's the yellow line here. That's also showing some weakness. We have staples and healthcare, which are really more defensive, value-oriented things. They're coming up a little bit, but they're still lagging behind everything else. Then we have all of the additional sectors, which are showing some improvement. When we go back and look at the sectors just for the week, now this is just the 5 trading days, the 14th through the 18th. Every sector ended up being down on the week, as we just saw. Going back to the beginning of the year, and this is an incorrect chart. This is also for the latest week, so disregard this chart. Going back to the all-time high, energy is still up since that time, followed by industrials, where all of the other sectors are down. Looking at sentiment, we've really been dropping down. We're more in the neutral area currently. In fact, we're already down to the point where we could be heading over into the fear camp. So when we look at the historical chart, we had been up above 75 and now dropping back as more fear has been coming into the market. The active asset managers, after giving us an extreme positive reading, it's been dropping down. These folks are emotional too, even though they are professionals. Here's another look at that same chart coming in at 59.87, where they had been able to get above 100. Looking at the VIX, we did see an increase of fear with the line chart as well as the bar chart. The Ulcer Index is also showing a bit of a tick up. We've crossed above the moving average on the daily chart. This one is going a little bit slower. When we look at the Right-X Bear Bull ratio, we would think this would really have spiked up because these folks tend to react to what's already happened and there's been weakness in the market, but really we're still neutral. It's been ticking up just a little bit. The higher this goes, the more fear there is in the market. When this goes down, it's kind of like the VIX. That means that folks are more bullish on the market. We had the latest reading of the American Association of Individual Investors. We're still above zero, even though we did decline. These folks also tend to react to what's already happened. We're also watching this red line where it is coming back up, but it's still below zero. Then we look at cash and compare it with the tech sector, way over here on the right-hand side. It is ticking up, but it's still below this Ichimoku cloud. When we were coming down here, that's when tech was doing really well. So this is inverse to what your logic might tell you. When we were spiking up with this, that's when we ran into trouble in 2022. Looking at the economy, the latest readings for GDP, we're having that be revised up. We're getting up just under 6% now with the estimate on the high side and about 3.5% on the low side. The consensus of the range from the top 10 and bottom 10 go from about 2.5% on the upside to about just a little under 1% to the downside. And you can see the wave of how this has been changing over a period of time as they're revising up their GDP. And that's part of the economic strength that's giving a little bit of concern to the market. And we're also seeing that wave up with the GDP now estimate. This is what it looks like on a bar chart where it really shows some pretty significant strength over here, and that has the market a bit concerned. We want growth, we just don't want too much of it, meaning that interest rates will still be raised. Looking at the spread between risky and not as risky bonds, this is ticking up just a little bit, but when we get concerned is when this really starts to go up. There's also a pretty strong non-correlated relationship between these two. So this chart is not really causing us any concern right now. Looking at the latest reading of the financial conditions, we're still under the black line and declining. That is showing not a concern. These next charts have not been updated since the last time I did a video. This just shows that the tightening standards continue to increase. The real-time SOM rule recession indicator has not been updated. We're still around the black line. We get nervous if it goes to the red line. The smooth U.S. recession probabilities also, we get nervous at the red line. We're just a little bit above the black line. The Brave Butters Kelly leading index. This is causing a little concern, but it hasn't been updated since the end of July. It had been starting to go up, but then has been leveling off. So we'll be watching to see if this is updated. Keeping an eye on inflation, it's pretty much down a little bit from where it was a week ago and pretty much flat. We're not seeing a lot of changes in the inflation forecast. Where's the Fed at right now? There's still an 89% chance that they're going to leave rates unchanged at the next meeting on September 20th. That's ticked down 1%. And you can see the dark blue area. That's where we're at now. This is where we were a day ago, a week ago, and a month ago. So there's not a lot of concern going into this chart, at least yet. It'll get more active as we get closer to that meeting. Keeping an eye on the Fed balance sheet, showing a decrease. And then when we look at it year over year, also showing a decrease in Fed assets. Looking at this chart, the advanced decline line, where we're ticking down just a little bit based on price and volume, but we're still above the moving average. We're still above the moving averages on the daily charts too, but we're showing more weakness. Looking at the highs and lows, we did see more new lows being generated this past week. Our 4 period is declining and our 10 period is also declining and in danger of dropping below 0 longer term. The advanced decline ratio is still above 0 and was actually up just a little bit on the week. This is what I've been watching on the daily charts. We're dropping below the moving average on the daily chart. We're coming down to the moving average here on the weekly chart of the accumulation distribution. This tries to measure what is the smart money doing. Keeping an eye on our trend. We're still positive with the green line on top, but you see how the ADX is rolling over, but it has not crossed below its moving average, at least yet, and we're seeing the red line starting to come up. Keeping an eye on our Arun. We're still positive here. We're above 0, where we've turned negative on the daily chart. We were pretty much flat from this week to last week, where the green line on top measures the buyers, and that's decreasing. But we can see the red line is also the sellers are decreasing, so our oscillator is still hanging in there. The mass index is not generating a signal right now. We're seeing a little more movement in this on the daily chart. We're getting up a little bit closer to this red dash line, but it's not there yet. Looking at some other charts, here's the daily chart where we came down to this previous high. Did we set some kind of support here? This marked a pretty short-term low. It also came down to the recent high. And then this bar for the day actually looks kind of positive, where we open near the low and then close near the high. And that's kind of the scenario that I've been working with in the daily video, is that we're maybe seeing some things coming together that often happen when there's a bottom in the market, but we're seeing no confirmation of that yet based on price. Looking at our trend channel, we're still positive, even though we're declining, because we're above the midpoint of the trend channel. This was the resistance level. We came right up to this level, and we've been having trouble since that time, and we've been declining. That's why it's a good idea to keep an eye on these pivot points. The 50-period simple moving average, we are declining, but the red line is continuing to go up and price is above both. The long-term trend, even though we're dropping down below the 13-period moving average, we're still in an uptrend in the longer term. The McClellan oscillator, this is another thing on the weekly chart. We're starting to get to an extreme negative reading. We're also seeing that on the daily chart. So when we look at our summation index based on price, we're still above 0, but declining, and we've dropped below 0 based on volume. But the fact that the McClellan oscillator, which this chart gets its figures from the McClellan oscillator, the fact that it is getting an extreme negative territory could be positive for this chart. Just something to be aware of. Keeping an eye on the Swenlin trading oscillator, we're declining based on price and volume and below 0. So this is more negative. The BPI, the bullish percent index, we're seeing almost this exact same chart on the daily version of it, where we're declining, but we're still above 50. So we're negative in the shorter term. Until we drop below 50, that will turn things more negative if that happens. Keeping an eye on our momentum oscillators. In the short and a little bit in the intermediate term, we're starting to see some weakness. The PMO is still positive, but it's rolling over. We're declining based on price and volume and below zero. When we do our PMO studies, we're getting extreme negative with the PMOs that are rising, same as the daily chart. We're getting extreme negative with the buy signals, same as the daily chart. And we're still declining with the PMOs that are above zero. And this looks almost exactly like the daily chart. The percent B indicator, we're still above zero, even though we're declining. Here's our oscillators. We're turning down in the short term. That's the slope and the TSI. We're rolling over with the MACD, the PMO, and the PPO. Those are our intermediate term oscillators, but our long-term oscillators, even though they're rolling over a bit, are still looking positive. The Chaikin money flow, which tries to look at what the smart money is doing, it is declining, but it's still positive. We're kind of getting extreme negative on the daily chart. And sometimes when that happens, that marks a pretty good bottom in the market. The Chaikin oscillator is dropping below zero and declining. That is more negative. The force index is just barely above zero and has been declining. That's turning more negative. The money flow, after being extreme positive, is dropping down, but still above 50. The rate of change was negative since we had another down week. Going back 50 periods, we're still seeing some strength. Looking at the RSI on 14 periods, we're declining, but still above 50, where we're starting to get more short-term extreme on the daily chart. On the more intermediate chart, we're just plain negative. The special K, the daily chart is still positive. The weekly chart is right below the black line, and that is negative. The Stochh RSI, after being extreme positive, has now gone extreme negative. And the Williams percent R, after being extreme positive, has dropped, but it's still below the midpoint, hanging on to a slight positive edge. The ultimate oscillator, this is more negative. After being extreme positive, has dropped and has now gone below 50. The vortex, even though it's declining, the green line is still on top. The Copic curve, and notice I changed the spelling over here, where we're not getting a signal anymore from this chart. Keeping an eye on our longer term moving averages and fib lines, where we are dropping below the 10-week moving average, which is kind of normal for a pullback. That would equate to a 40 to 50 day moving average on a daily chart, and we're seeing that weakness as well. But we're still above this longer term red line, which would equate to a 200-day moving average. Here it's a 40-week moving average. Our different charts, the Heikin Ashi weekly chart is turning more negative. The Keiki chart is still positive, but the black line is coming down. The Renko is still positive. The 3-line break is starting to turn more negative. The ease of movement, and I follow the 14 period for the most part, we're declining, but we're still above zero. We did see a couple of new O's drawn in, and that's not a good sign. That's more negative. And the signal that we had been working off of back in May 15th, when it was generated, that is now gone. So the point and figure chart, both in the daily version and here on the weekly version, are turning slightly more negative. We're switching more negative with the Elder's Impulse system for the S&P, and we continue to be negative with the parabolic SAR. That's because the dots are on top. The PPO, long-term, seeing a little bit of weakness. Also, a little bit of a downturn here in intermediate term land, but we're still positive where we're dropping negative in the short term. Here's some daily charts that I thought you might find interesting. We're dropping below this intermediate term trend line. We broke through that support, and we're wondering, are we going to hit a bottom somewhere in here, or are we going to continue down to this longer term trend line? The 50-day cycle, which happened right on August 1st. That's kind of when we started to run into trouble. Well, it's living up to being not a very good cycle, at least so far. Now, this could change at any time, but for right now, it's been fairly negative. When we look at the ratio between the Dow and the transports, when this is going back up, that means the Dow is outperforming. We want to see the transports outperforming in a more positive environment. Keeping an eye on our fib levels for the NASDAQ. This is a daily chart. We came almost down to this fib retracement level, and then we actually ended up closing up off of this low. That could potentially be positive if the NASDAQ will count that as support. Also with the NASDAQ 100, we're still above this S2 level, even though we came down to it, but we closed near the high on Friday. Looking at the broad market, where August tends to be down and it's only up 40% of the time, where September is even worse. It's only up 25% of the time, and it ends up being down 4.1%. Just a blank chart looking at the S&P, mid caps and small caps, we're seeing pretty much across the board weakness. The Dow is still in an uptrend and coming down to this 13-week moving average. The NASDAQ broke below its 13-week moving average, but still in an uptrend. NASDAQ 100 below the moving average, but still in an uptrend. The mid caps, it's going to be a broken record here. Below the moving average, but still in an uptrend. Small caps, we saw a recent golden cross here on the weekly charts. We've come down to the red line, which is the 50-week moving average on this chart. Then looking at the NYSE, we're still in an uptrend and just a little bit below the moving average. Looking at all stocks, some weakness, but still in an uptrend. Biggest software companies dropping below this longer trend line here. So I'm sorry, dropping below this moving average here, but still in an overall uptrend. The FANG stocks dropping below the moving average, but still in an uptrend. ARK coming down to the longer term moving average, but still in an uptrend for now. The banks kind of got spanked a little bit this week. You can see how they fell. We're dropping below 50 with the RSI. The MACD is still positive, but could be starting to roll over. The deposits, we saw a little bit of a tick down as some more fears coming back into the market about banks. Looking at Dow theory with no studies on here, where the Dow was down, the transports were down, the utilities have been down even more. Some broad market measures that we look at. The CRB index was down on the week, and we could be getting ready to see a golden cross here on this chart. Oil, after getting up into the mid 80s, is now dropping down to the, what is that, 80.66. Copper has been chopping around all over the place. We could be seeing a death cross soon, but we haven't seen it yet. The dollar, believe it or not, and the weekly chart of the dollar is looking more positive than the daily chart. We're getting back to a potential long-term golden cross here, where we've got a long ways to go when we're looking at the daily chart. After dropping below 100, the dollar has really been bouncing up, and that's been giving a lot of headwinds to stocks. Gold has been seeing some weakness, but it's still in an uptrend. Kind of the same thing with silver. Weakness, but an uptrend. Looking at bonds, we're seeing bonds really starting to trail off, and we could get ready to see a death cross with the total bond ETF. But stocks still continue to outperform bonds on the monthly chart. We're still below zero with our one month yield minus the 3-month yield. We came right back up to zero. We were there for a couple of days, and now we're just slowly dropping back down, which is how it should be. Here's the daily chart of yields, where they were really going up for most of the week, but they did turn down a bit on Friday. A weekly chart showing that the UK has the highest rates, followed by the US and Germany. Japan, again, it's its own little story that we're keeping an eye on. Their rates are purposely low right now. Some relative studies, looking at an intermarket analysis chart going back to the beginning of 2023, stocks are still doing the best. And then we kind of have a conglomeration here with oil starting to show a little bit of a comeback. Gold and the dollar, kind of all about the same right now, where bonds have gone negative as interest rates have been going back up. If we go back to the beginning of 2022, oil is still in the lead, followed by the dollar, and then gold and stocks and bonds are still underwater. When we look at some ratios between the NASDAQ 100 and the S&P, showing some weakness, but still the NASDAQ 100 is outperforming. The S&P 100 is continuing to outperform the S&P 500. And when we look at growth to value, growth is outperforming, and it actually turned up just a little bit. This is what we're looking at a little bit under the surface, especially later in the week, this past week. When we look at gold to the S&P, it is really underperforming, and we've seen a recent death cross. Gold has also been underperforming when compared to the dollar. Bonds continue to underperform stocks, and low volatility stocks are underperforming the S&P and in an overall downtrend. Discretionary is still outperforming staples, even though we saw a little bit of weakness in this ratio. Energy, which has been bouncing back, is still underperforming in the longer term when compared to tech. Our long-term secular and cyclical trends. We're still looking okay with our NYSE breadth thrust. There was a signal that was generated when we hit the low in October of 2022, and this is hanging in there. The next chart is a little scary, and I have not been able to find any information on this yet. Everybody tells you what a ZWAG NYSE breadth thrust buy signal is, but when does this signal go away? Look at what's happening. If something really positive were to happen, we might generate another signal. And these signals are very rare indeed. So I'm not sure if that takes this off the table or if we're just going to kind of keep an eye on this. But we're still positive when we look at the Zohorchak method. It has not fallen from its buy signal. Keeping an eye on the weekly chart of the S&P, we're dropping further below the resistance level. We're also dropping a little bit further with the NASDAQ 100. We also look at the NASDAQ 100 to Dow ratio on a weekly chart where we came up to a pretty high level and we are falling down slightly. This could be longer term negative. Our momentum studies. The only reason I'm bringing this up is not because of the momentum study. We validated that the breakout above this trend line was already legitimate. Enough time has passed. But on the weekly chart, you can see where the MACD is showing some weakness, as we saw on the oscillator chart. And if we see more weakness, we could drop more to a negative stance. This is the research from Tom Bowley, where August is the third worst calendar month. And get this, what's not hot is energy, and that's been hot. What's hot is tech, and that's not been hot. So it's just the opposite. It's like bizarro world right now. Well, we're coming up to the latter part of the midpoint of August where we tend to see some good returns and then some weakness going forward into the end of the month. Also, from the period of May through August, growth tends to outperform value, but we're really not seeing that unless you count the last couple of days, but we want to see more of that. So what's our outlook for Monday? There will be earnings reports, and all of this is just based on Monday's outlook. The technicals on the daily charts are negative. We're becoming more oversold, but we have to ask ourselves, is a bottom starting to form? We won't have any economic reports coming out on Monday. We're keeping an eye on the geopolitical events. It's about inflation, interest rates, and growth concerns right now. Here is the calendar for the upcoming week. No reports on Monday. The most important one that I can see here, we'll get durable goods on Thursday, and we'll get, this is going to be a real good one here. Fed Chair Powell's going to give a speech at Jackson Hole. If you were in the markets a year ago, we were just screaming higher. We were sure the Fed was almost done raising rates, that inflation was all under control, that it already topped out and was starting to come down. And then he comes out and gives a speech and just blew that whole thing out of the water, and we suffered for the rest of the year. Is something like that going to happen this time? We'll be watching. Or is he going to say something that will actually make the market happy? Or is he going to say something that is irrelevant? We don't really know what's going to happen with that. Looking at the Stock Traders Almanac statistics for August 21st, we're negative with the Dow and NASDAQ, where we're neutral to negative with the S&P 500. Here is the pre-election cycle, and the green line is what we look at for the S&P, where we should be seeing a nice little bounce here, but it just hasn't materialized yet. We should also be seeing a bounce for the NASDAQ that hasn't happened yet. And when we look at the S&P 500, which is the green line here, we should be seeing a little bit of a bounce, but it seems to be MIA right now. We will be on the 15th trading day of the month, and I have another chart after this. We're outside of this little window right now where we typically see some kind of a bounce based on what has happened in the past. We will see some little bit of weakness, then a little bit more strength. We're wondering if it's just being delayed this year. So our scenarios, we're going with the down one on the daily charts. Even though we're becoming more oversold, all of our indicators continue to point down, but we have to ask ourselves the question, are some things coming together that may be forming a bottom? We're definitely not going with the up one unless you're like a daredevil. You might be able to go with the sideways trend because our short-term ADX, it's still below 20, even though it's turning up and coming back over the moving average. But if you're a longer-term investor, you might want to wait to see how that plays out. The warning signs. We hit that pivot point and we've been coming down, and we also saw a convergence of these short-term bearish signals. Like we're seeing some short-term bullish signals coming together. Well, these signals finally all came together and helped to drive the market lower. We're wondering, is this ever going to finish? The longer-term trend signals on the weekly chart, they may be signaling that we're at a top. We're coming down with the S&P and the NASDAQ 100. August is a weak month, but we're supposed to be experiencing a pre-election year euphoria right now that just is not happening. The S&P 500 oscillators on the daily charts are negative, and we're also keeping an eye on the negative NASDAQ 100 PPO momentum oscillator. The VIX is starting to climb after showing some complacency. The equity put call ratio is coming up, and this is one of these potentially bullish things that could be spiking, but it still could go higher than where it's at right now. All of the moving averages and the different indexes, they've all dropped below their 50-period moving averages. We're still seeing a cumulative weakness with the new highs, new lows on the NASDAQ. The 3-month yield is still above where we were at back in 2007. If that turns and starts to come back down, and we're getting some bad news or something at that time, we're wondering, will that give us some kind of a warning sign? We're seeing growth in a longer term uptrend, but in the shorter term, it's still weakening. But as I said, over the last few days, it was showing some strength. The parabolic SAR daily chart and weekly charts are negative. The vortex continues to be negative, where it's still positive on the weekly chart, but the green line is coming down, and then we're dealing with earnings season. Positive signs. We're supposed to have this seasonality and setups that are in the background. We're a little bit indeterminate right now with the ZWAG NYSE breadth thrust, but the other NYSE breadth thrust and the Zohorchak, those are still positive. The daily special K chart is positive, where the weekly is negative. The equity put call ratio, it's coming down, but it's starting to turn back up. We're wondering if that's going to see a shift. The S&P is still above the downtrend channel upper line. We're still in a risk-on posture more in the intermediate term, but we're seeing some weakness in that ratio in the short term. The S&P is outperforming utilities, and the staples are outperforming. The staples to S&P 500 ratio is declining, and when you take these together, they should be giving some support to the S&P, but we're just not seeing that. The Russell, the small caps, and the mid caps have generated recent golden crosses. Small and mid cap growth continues to be positive. The financial sector has generated a recent golden cross, and we're wondering, is there a convergence coming together of these signals that often happen at a bottom? Our conclusion on the daily charts: we are negative and becoming oversold. Are we forming a bottom? In the short term, we're negative and oversold. In the intermediate term, we're also negative and oversold. In the long term, we continue to be positive. One last chart. Going back to 1950, in pre-election years, the S&P's up and down 50% of the time. Thank you. I hope you found this helpful. Please, I hope you were able to get through this without too many cringes, but I hope you have a really good weekend, and I will talk to you in the next video.